Welcome to the NZ Everyday Investor. My guest today is Amanda Martin. How are you, Amanda?
I'm well, thanks, Darcy.
All right. Now, for our audience, you've been on the show a few times before. I know that you're a specialist tax advisor. You're not your regular sort of accountant. You're a bit special. Can you tell our audience exactly what you do?
Oh, thanks, Darcy. Yes, so I am a tax advisor, as you said, and my clients are typically other accountants and lawyers, and if their own clients have specific tax questions, they'll come to me. I also advise my own group of private clients as well.
And what I'd love to do today, I've had a couple of questions from our audience around this. I've had just interesting conversations even in this last week around tax questions which are well beyond the scope of my understanding. Mm-hmm. And I know even with some accountants, it would be beyond them. And that's why people like you exist, because it's just that next level up. And so I want to go straight to the source, figure out how it all works from an investor's perspective when we're investing in shares, because there's a few different ways we can tackle shares. So the first thing I want to know is that, let's say I have $150,000, 3 pots, $50,000 each, ASX, NZX, the US. Let's talk about how the tax treatment differs from country to country. Is that cool?
Yeah, no, that's totally fine.
You look scared, but I know you know the answers.
No. Okay, so with a share, obviously you're going to be deriving dividend income from that share. Yeah. So if we first look at how do we tax a share, a New Zealand NZX share, so say your Spark share. Most investors, if they buy their shares on what we call capital account as a long-term hold as an investor, they will be taxed on the dividend income. And as long as they didn't have the dominant purpose of resale and are not a trader, they won't be taxed on the capital gain or loss. Okay. So you'll just be looking at that dividend. So the company itself will derive its income. It'll pay tax at the corporate rate, which is at 28%. And then when those dividends, that income is distributed up to the shareholder, that 28 cents of corporate tax gets attached as what we call an imputation credit.
So in other words, like the tax that they've already paid, you don't have to pay it again.
You don't have to pay it again. So when that dividend gets paid up, we have that 28 cents. Then there's also a withholding tax, a resident withholding tax payment, which is usually 5 cents, which goes up. So you'll get your dividend cash in the hand, and typically you won't have any further tax to pay. That dividend goes into your tax return, and sometimes you might get a little bit of a refund of the resident withholding tax, or if you've got what we call excess imputation credits, because your total marginal tax rate is less than, say, the 28 cents, you'll end up being able to carry forward a little bit of a loss in relation to that income. Got it. So that's your New Zealand shares where you hold them as a long-term investor. Okay.
And it doesn't matter, by the way, it doesn't matter if you're holding these shares on Sharesies, Hatch, ASB Securities, whatever, it doesn't matter. It's the same treatment.
It's the same treatment.
Yeah. Okay.
If you are, the same treatment applies to ASX listed shares. So again, the same thing happens. We're not going to be taxing the gain or the loss. You'll get taxed on the dividend. Okay. But the difference is that company is paid Australian corporate tax, and their corporate tax gives rise to what they call a franking credit, which is very similar to our imputation credit. Now, we don't recognise the franking credit. Similarly, the Australians don't recognise our imputation credits. There are some instances where that Australian company might have a New Zealand business and there might be some imputation credit that can be attached, but generally speaking, you'll just get taxed on the net dividend. So where withholding tax has been deducted, Australian withholding tax has been deducted at up to 15%, then you'll get to claim a credit for that in your tax return. But typically there will be a difference, and there will be some sort of tax liability in relation to the income that comes from your Australian share.
Okay. When you say they don't recognize that, like, what do you mean by that?
So what that means is, in our New Zealand, for our New Zealand dividend, we put the gross income in our tax return. So if, for example, you've got a total dividend of $100, which is made up of $72 of cash, you've got 28 cents of imputation credits, and then you've got 5 cents of withholding tax. We return the full 100 and we basically claim credits for the fact that the tax has been paid. So typically for the New Zealander, there won't be any further tax to pay on the New Zealand dividend income. Yeah. From the Australian dividend, we look at the net dividend, the actual cash payment that you get. Yeah. That goes in as income in your tax return. So whatever your marginal tax rate it is, that's the tax liability on that income. And then we claim a credit if there's been any withholding tax. But the franking credit component doesn't really hit the calculation at all. Okay. So there is going to be a difference between the two.
Okay. So if we just think about this as an example, I'm an investor with a profitable New Zealand company and a profitable Australian company. I'm based in New Zealand. What does it look like if it's $100 of dividend income from a New Zealand company versus an Australian company, like in terms of how much tax I pay? Is it very, very negligible?
Ask me to do the sums of my
No, that's right.
It'll be, it's about up to about a 50-something% effective tax rate for in relation to the Australian income versus about a 33-ish tax liability. Okay. So there's about it depends on the marginal tax rate, etc. Sure. But you lose about 15 to 20% on the tax.
And I think that's kind of important, right? Because a lot of our investment decisions seem to be focused on the actual profitability of this investment strategy in this company. I want to buy those shares in that jurisdiction because you get better returns. But unless you're putting it through that next layer of tax.
Yeah, what's your post-tax return? Then you've got to be looking at that as well.
Yeah, and it kind of explains why a lot of fund managers will probably load up quite a bit in the New Zealand equities, because from a tax point of view, it's possibly in your best interest to do it like that.
Possibly.
Depending on who you are, of course.
Yeah, exactly.
Okay, so let's go a little bit further then, can we?
Yeah, we've got Australia, we've got New Zealand equities, and then we've got everything else. Yeah. Okay. So say you went and bought some shares in Tesla. So these shares, we have a set of rules called the Foreign Investment Fund Rules, FIF, and FIFs, you'll hear us talking about. Yeah. So this is a code which we ignore the trader distinction. So it doesn't really matter, you can be flipping in and out of these shares or not. We're not going to tax the gain if you're in these rules. Okay. So if your total cost of your foreign investment fund interest is $50,000 or more, you're in the regime.
Can I pause you there, because just for our audience, can you explain with that $50,000 cost basis, that's not per year, that's not the value of it, that's the cost of it.
It's the total cost of all FIF interests that you hold. If you're over 50,000, you're in the regime. Okay. If you're under 50,000, then you're taxed like the Australian or the New Zealand shares, where we're just looking at dividends.
Got it.
Unless you're a trader, in which case we will then tax the gain or the losses.
Okay, but it doesn't matter if that portfolio has spiked up to 100,000 because your cost was 50 or less.
It's cost, it's not value.
Okay, no, that's cool. So keep going. So the rest of the world.
So say we're in the rules because you went and bought your $50,000 worth of Tesla shares. Yes. So there are two options. One is called the fair dividend rate method. And what that does is it looks at what is the opening market value of your FIF portfolio at 1 April of any income year. It says, okay, well, we've got what is 5% of that? And then where there is an adjustment if you're buying and selling those equities within the same year. Okay. So where this rule came from was many years ago, they looked at what is the return people are getting and declaring on their income. And they looked at, well, the New Zealand and Australian equities are yielding more. And they arrived at, well, we think 5% is a reasonable return on your
an arbitrary number.
It's an arbitrary number. Right. Okay. So that is one method. And then there's another method which is called the comparative value method. And that looks at basically your overall gain on the portfolio during the year. It compares the opening value with the closing value, and then we take into account dividends and actual realised gains. So you have these two numbers, you can compare the two, and you take the lower of. So the idea is that it's effectively a cap at 5% plus any adjustment if you've made gains on transactions that are occurring within the year.
So if I have $51,000 of Tesla shares, and hypothetically, if there was a dividend of $1,000 using the FDR method, the fair dividend rate, talk me through how that gets treated.
So if that's the case, we've got an opening value of 51,000, 5% of that is income, and then I apply my tax rate to it. I ignore the dividend.
The dividend is completely ignored.
The dividend is utterly irrelevant.
Got it.
So we are not in the fair dividend rate calculation.
Right.
So there is this disparity between cash return and this deemed return that you get under the fair dividend rate method.
Right. Whereas the comparative value in that situation, measure at the start, measured at the end.
And the difference between the two, and we also take into account dividends, which feeds into the calculation. So you'll often only use the comparative value method is quite useful. For example, in the 22 income year, I'm anticipating to see a lot of the comparative value being the method that gets used because a lot of the markets move down. Now, it's important to note that you can't pick and choose which method.
I was just going to say that. That's right. Because that sounds like a nice little trick there.
It does. I've plugged that trick.
Yeah.
No, you need to apply the same method as a whole portfolio. So if you've got some hatch portfolio, Sharesies portfolio, and something with another fund manager, you've got to look at it as one big portfolio.
Sure.
So as much as the reports are all useful, you've then got to take a step back and apply them across the board.
Right. So if I chose to use the FDR methodology, that's going to apply no matter what platform I'm using, whether it's managed funds or directly held shares. So if you believe that we were going to be going through a period of say 1 to 3 years where it might be pretty flat or even pulling back a little bit with your portfolio and you kind of just wanted to ride it out, then using the CV methodology may result in much better tax treatment than the FDR methodology.
Yeah, correct. Now, you can't take a loss. So your floor is zero.
Okay.
So, as much as I said, let's look at what 22, well, it'll be interesting to see what happens in 23. That, the markets were down, although probably not as far down as they have since gone.
Yeah.
So it'll be interesting to see where we're at come 31 March 23.
Right. But that kind of connected to that is that whole we can't get a loss, we can't get a tax credit because our portfolios are down. So that would be cool, wouldn't it? We can definitely pay tax, that's all good, but we just can't take a tax credit because we're going
exactly.
backwards.
You can't take into account that last year was a dreadful year, if that happened, and you can't carry forward that loss. So
Okay. So far, what I'm picking up is that if you're investing in shares in New Zealand, we're going to be paying, and you're a long-term investor, you're not a trader, we're going to be paying tax on the dividend income, and there'll be a wash-up based on the tax that the company has paid before it gets to us and what our marginal tax rate is. If we're doing it in Australia, works in a similar way-ish, but it's not necessarily as tax efficient. Therefore, you kind of need a higher return on the ASX to make it worth it from our perspective. And then in the US, it's pretty much the exact same treatment as long as we're under $50,000, right?
correct.
Cool. And that's when above 50,000, we have that choice in any given tax year to choose two different methodologies that might be better. We just can't choose based on portfolios. We can't mix and match, but it's based on the tax year.
Exactly. And so that choice, that's for individual taxpayers and trusts. Okay. So if you're a company, you don't have the ability to apply the CV, the comparative value method. Okay. And so that's where managed funds, they have to apply the fair dividend rate method, and there's some sort of adjustments to the way that they calculate it.
Sure.
So sometimes in the declining market, you might still see some tax liability.
Okay. Well, let's get into that, because that's kind of touching on one of the questions from our audience was, hey, I've got an index fund, which is, I believe it was an S&P 500 or S&P 100. And the fund value has actually declined, but I'm still paying tax.
Yeah, that will be because, well, it depends, what's in the portfolio. But in relation to the FIF interests, it will be applying the fair dividend rate method that applies to funds. So they won't get the benefit of the comparative
Got
value
it. Okay.
methodology.
So let's unpack that a little bit. So we've got a $51,000 of directly held Tesla shares was our previous example. Let's say we have a $51,000 portfolio that we just set up this year, and it's in a managed fund based in New Zealand, which is investing in U.S. companies. What's the difference? What does it look like from that tax picture?
Well, for the fund, if that was its only, no other transactions, no units bought and sold, you just held it like that was all it was.
Yeah.
That would be the 5% under the fair dividend rate method. So it would be your 5% of your 51,000 would be the number that would spit out.
Because it's a company.
Because it's a managed fund. It's a company that's holding the where you're buying the units in the managed fund.
Got it. And take that apart a little bit. So we have this thing called PIE, P-I-E, Portfolio Investment Entity.
Entities.
And if you are investing under that example where you have $51,000 worth of this managed fund, which is investing just in the U.S. share market and Tesla, let's say, but it's via this managed fund, it's going to be taxed at the prescribed investor rate. And if it's 28%, but your marginal tax rate in New Zealand is even up to 39% on some of your income, then that could be a really efficient vehicle for you to be doing this with, right?
Correct. Yeah. Just remember that they won't have the benefit of the CV. The fund will be applying the fair dividend rate method. No
matter what. So you can't choose.
In volatile markets, it might not work. But if you've got a steadily growing market and portfolio, and if you assume that the shares will progressively, consistently go up in value, then you get a better result.
Okay, no, that's cool. So there's so many different little layers of consideration here that you kind of have to think through, right?
Yeah.
And so the U.S. then, there's nothing necessarily special about investing in the U.S. from the New Zealand perspective versus, say, Europe, right?
Yeah, it's basically it's everywhere else in the world other than New Zealand and Australia, Australian listed equities.
Okay, so we've covered a lot around this so far, but now I'm starting to think about Bitcoin. Because that's just kind of what I do.
Your favourite thing to
It's
talk
my
about.
favorite thing at the moment. So if I was investing in Bitcoin, we now have so many more options. I probably shouldn't say investing in Bitcoin. If I was holding Bitcoin, we now have so many more options than what we did even just a year ago. Like we can set up a Kiwi Saver fund and put Bitcoin in it now, which I think is amazing. But with a lot of people, they may choose to separate out their direct holding of Bitcoin and their indirect via managed funds, just to manage that custodian risk. And I think that's a really smart way of doing it. But from a tax point of view, if we were just holding Bitcoin in our digital wallet and we were in a rising market, which happens every now and then, versus putting it into a managed fund, the tax treatment is different, right? So
correct, it is.
I want to unpack this a little bit because this is fascinating. It's not too dissimilar, but it kind of is. So.
Yeah, so I suppose the start point is, well, if we would hold it directly, what would the tax treatment be?
Yeah.
And there is still a whole lot of conversation around what is the correct tax treatment for holding a Bitcoin. But the basic start point, and certainly the IRD's view, is that there is no income that can be derived from Bitcoin, and let's just park the idea of staking, etc., to one side for the moment. So they see it as analogous to holding gold. And the IRD's statements and sort of case law is looking at, well, what was your intention when you acquired the Bitcoin? Was the dominant intention to sell? So it's under one of the taxing provisions, which looks at property. If you have the purpose of disposal, then it's subject to tax. Yeah. So if it goes up, it's taxable. If it goes down and you dispose of it, it's a deductible loss. Yeah. So that's the start point. So if you bought gold, say $50,000 worth of Bitcoin, and held that and then sold it or otherwise disposed of it, say for example you traded out to Ethereum, then you've disposed of it. The New Zealand tax treatment would be, we would look at the difference between the proceeds in New Zealand dollars and the cost in New Zealand dollars. It's all taxable. taxable or deductible. Say you held that same Bitcoin in a overseas fund. It's usually would be an exchange traded fund, and say that fund, all it did was hold Bitcoin.
Sure. So now that key distinction is really important to underline. That's like from me in New Zealand owning units in an overseas
fund. Index fund.
Okay.
Then that fund would have its own, it would likely be paying tax on its holdings.
Yes.
Most countries have actually sort of fallen down the path of deciding it's subject to tax. But in terms of your personal tax obligation in relation to it, that ETF is a FIF interest. So if you're in the FIF rules, because your cost is more than $50,000, and then you're under this fair dividend rate versus comparative value, we see that ETF like a company, it's like a share in a company. So your tax liability will be up to, assuming you don't dispose of any units, the income will be 5% of the opening market value, and then there'll be an adjustment if you buy and sell those units. And then you'll compare it to under the comparative value method. What's the value at the beginning and at the end? So in a rapidly rising market, you can cap your annual income at 5%. Bearing in mind, no disposals actually occurred. So you've got to fund the tax liability even though you haven't actually exited. But quite often with cryptocurrency, the disposal event still occurs when you go from Bitcoin to Ethereum. So you haven't really got any real money cash to pay that liability anyway. So you're actually able to effectively manage your tax through ETFs. That's offshore.
Got it.
New Zealand, well, the fund will be subject to tax. So again, you'd be just looking at whether it might be a pie entity. It'd just be like any other asset, but the fund itself, if it was buying it, selling, it would be paying tax on that income at the fund level.
Okay. So if I was to just try and be a bit clever around this, if we went through, say, 3 years of a pretty flat sort of environment where it was just all about accumulating Bitcoin, accumulate as much as you can, a little bit of movement up and down, but more or less not a lot of excitement going on, then from a tax point of view, I guess it's more efficient just holding it directly. But if we were going through a massive run-up in price, then owning it via a fund might be more efficient?
Possibly, yes. If you're holding it directly and there's no disposal event and all you're literally doing is just holding it, then there's no disposal. There will be no tax liability on it.
Yeah, that's right.
But then if it starts rising up, you're correct. It might be better to hold it via an ETF.
It all depends on what your intention is, really.
Yeah, and also there's a whole lot of other issues. Security. Do you trust the fund?
Yeah, that's true.
What's their security like?
Yeah.
What is the the rules that apply to the fund as well.
Yes.
So,
okay.
This is just looking through the New Zealand lens.
That's right. None of this is tax advice, right, Amanda? Are you pretty
correct.
confident in that?
Yeah, absolutely. Please, none of this is all just general comments.
Yeah, which is impossible to be tax advice.
And it's not financial advice.
Yeah.
Either.
No, that's right. So, because we don't know anybody's situation that's listening, but I guess I'm just trying to think about this being really clever, which of course I'm not. I'm just trying to think about all the different angles here. I'm not trying to outsmart the system, but if I was busy accumulating, and let's say I had $100,000 worth of Bitcoin, and it was during the flat time, and I really believed with the next halving event it was going to go up to the moon again, and I wanted to get out at the peak, if I was that brilliant to time this perfectly, I could move this all into a managed fund and ride the wave up and then sell at the top. Is that possible?
Yeah, potentially you could. It's a lot of crystal ball gazing, and you'd have to be pretty good,
brilliant.
pretty brilliant.
Yeah.
But you just need to be mindful if you were selling your actual Bitcoin that you held directly, and then that's a disposal. Correct. So you'll have to be taking that transaction into account for tax.
Yeah.
You really are having a view of the future by timing the market.
Yeah.
But say it was on the halving or...
Let's say it was $30,000 US to buy Bitcoin, and it was hovering around that for the entire 3-year period. So my cost to get in has been 30,000. I dispose it, really no gain.
No gain.
Theoretically.
Yeah.
Put it into a fund, then it goes to the moon. I could sell it at $100,000 per Bitcoin, and now I'm
Well, yeah,
killing it, right?
but you are for each year that you are holding it until
Right.
it gets to 100.
Yeah.
And you just also need to be mindful of that that quick sale rule. So
Sure.
it would need to be spent over 2 income years.
Take me through that quick sale rule.
So that quick sale rule looks at where you acquire, say you were to acquire an ETF or a share in an income year and dispose of it in the income year. We look at the gain that has been made and we compare that to what the average cost is of that. So
Okay.
effectively what it means is you are taxed on your opening market value at 5% plus 5% of the average cost of the units.
Got it, yeah.
So in your perfect scenario, you would be acquiring something after the 1st of April and then disposing of it in the next income year.
And have a genuine change in purpose around why you're acquiring that asset, just to be totally safe, right? Because you don't want to be deemed to be a speculator.
Doesn't matter.
Oh, it doesn't matter at all.
Well, you're in the fifth rules.
So you're playing by the rules, and that's right. Yeah. So you can be a complete trader when you're inside the fifth rules, right?
Correct. Yeah, correct. And that's quite hard for people to get their heads around because we always have this: am I a trader? Am I not? You know, am I acquiring? You know, am I just rebalancing my portfolio,
That's
which
right.
you'd say is not a trading activity? But we do look at the frequency of transactions, the activity, the level of commitment that you put into as to whether you are a trader or not, whether something's held on what we call revenue account or on capital account.
Okay.
With the fifth rules, that distinction is parked.
Sure.
It is a code that we overlay over these types of interests that we hold in offshore.
Okay, so it really pays to just think about that. So we need to be paranoid of being thought of as a trader only if we're not inside the fifth rules. But if we're over $50,000, then hey, you can come out now. It's okay, it's safe.
Well, you can, and I suppose you need to be mindful that if you are actively trading your global equities, you need to be very clear, okay, well, what's your activity in relation to perhaps your New Zealand and Australian interests?
Sure.
And is there a blurring of the two? Are the portfolios kept very separate? So you do have to a little bit think about how that might be looked upon in terms of your ones which are subject to that distinction.
Yeah, got it. And just maybe a little bit of speculation, just for fun, because we can. And it's Bitcoin, so speculation comes with the territory. But in terms of the tax treatment, it feels like almost every jurisdiction is now singing from the same hymn sheet around that. But do you think that might evolve and morph a little bit?
Broadly speaking, I think all governments are concerned about cryptocurrencies and Bitcoin and all the other different coins. But I think the horse is bolted and they're all realising that they have to actually deal with it. So most tax authorities, certainly that I've seen, are all singing from the same song sheet, that it's taxable, and are trying to actively encourage disclosure and compliance.
All right, so when we were chatting before we hit record, we were chatting a little bit around the what kind of we both probably think has happened a lot since COVID struck, and what will likely continue to happen, which is New Zealand will be the recipient of a lot of people with wealth coming here. That's probably more my gut feeling. I don't know about you, but I kind of genuinely believe that New Zealand is like going to be a magnet for a lot of uber wealthy people to come here.
Yeah.
What do you think on that, by the way?
Certainly, we've seen, there's certainly over COVID, there were a lot of people coming to New Zealand during that period of time. And, some of them would have fallen in with that high net worth category. There were also a lot of returning Kiwis from overseas. And just, I suppose, with everyone working from home, people suddenly opened up their world to, actually, I can work and live in different places. I can work for, my employer in America and live in New Zealand. So we did see a lot of people coming into the country, and the investor category visa, which is, there's a couple of thresholds. as anecdotally, I think there was a large increase in those applicants that came to New Zealand. So, and I know there is a group of very wealthy people that have come into the country.
And you would know that because that's basically your target
so
market.
I work a lot in this space, and we've obviously got a really complicated set of rules. These people have homes in various places. They are have a tax presence and tax residency in different jurisdictions as well, and we have to work out how it all interconnects and how we sort of smooth ourselves into the New Zealand tax space.
And there's probably a whole lot of complexity here, and we won't go too deep into it, but I would love to pick your brains on a scenario that I often see, which is where, maybe we'll keep this really simple, where I'll see a New Zealander who has spent, say, 5 years over in the UK. They bought a home, had a life there. They wanted to come back here, perhaps during COVID. They kept the home in the UK. It's rented out. It all works fine from a cash flow point of view. They buy a property here and off they go. They kind of forget about the UK in a sense. That's a passive investment, I think, in their minds. But it's not necessarily passive from a tax point of view. So can you talk me through the considerations?
And just touching on that, and I'll cover both, the Kiwi that's been away for 5 years versus the Kiwi that's been away for 10 years.
Good point, yeah.
So first, if I group perhaps the Kiwi that's been away for 10 years with all the other people that are coming into the country so that we can cover that off.
Okay.
So a new migrant to New Zealand or a returning New Zealander who has been non-resident for 10 years can come back into the country, and once they trigger New Zealand tax residency, then they are theoretically going to be subject to tax on their worldwide income. However, we give a period of time called your Transitional Residence period, which is a period that runs from 48 to 54 months, depending on a couple of criteria. During that period of time, your foreign income, other than employment or service income, is tax exempt. So what that does is it gives a period of time to rearrange your affairs, get yourself settled, make sure you want to come and stay here, and before you decide to fully come into the New Zealand tax world,
try before you buy.
Yeah, try before you buy.
Yeah.
And that's a really useful period that we have. So that's what a lot of the new migrants that are coming in from different jurisdictions or your returning Kiwis are dealing with.
Sure. So they come here. They don't need to worry about anything for between.
Yeah, we don't have to worry about anything other than what they're getting paid for the work that they're doing. Yeah. And then we've got this lovely period of 4 years, and we look at their investments, we do any restructuring that's required. Okay. The idea is to smooth that transition into the New Zealand tax space. Okay. So to become a tax resident in New Zealand, you satisfy those domestic tests when you spend 183 days in a 365-day period, or you get what's called a permanent place of abode. And a permanent place of abode is a dwelling. It's essentially a home, a place that you have a real connection to.
That you buy or just rent?
Doesn't have to be bought. It can be rented, but you've got to live in it. You've got to be connected to it. And so this transitional residence period runs from 48 months from the end of the month in which you satisfy either of those tests. Okay. And at the end of that period, you suddenly come off that, and you are then deemed to acquire your foreign investment fund interests, your FIF interests, your financial arrangements. Suddenly you'll have to report on that UK rental property, which you've now got, and you'll be effectively taxed on the worldwide basis.
So just define that a little bit. You're deemed to acquire. So after the transitional period is complete, you're deemed to acquire. Does that kind of mean like you're buying everything that you already have overseas, you're actually buying it?
Only certain types of assets. So for example, your FIF interest, you get a cost base at the New Zealand dollar market value on that transition. So if you come off on the 31st of May, that immediately following in the middle of the, stroke of midnight, you then acquire those interests, and that is your cost base.
Okay. Mm-hmm.
Same for financial arrangements. So financial arrangements include non-New Zealand dollar cash deposits, so if you've got some pounds or US dollars, if you've got a loan in sterling or US dollars, you are deemed to acquire those at the New Zealand dollar equivalent on the coming off.
Okay.
Other assets like cryptocurrency, for example, property, other types of assets, you don't get a new deemed cost base. It's just that the income is returned from the point in time which your transitional residence ceases.
Okay, I think I'm following you here so far. Yeah. There's a few pieces there, isn't there?
There's a few pieces, and I'll just ignoring the piece. We also have our double tax treaties, which consider where someone is dual resident. But let's just say the person has come here to live here, and they are only New Zealand resident, so they've become non-resident in their home country. In that scenario, after that point in time, they're then taxed on a worldwide basis. So for a lot of these people, it can come as a bit of a shock when we talk to them about our FIF rules, for example. You know, that's
because they're a bit quirky. They're different.
Really quirky, and they're really different. And sometimes, people have difficulty appreciating that you're actually going to have deemed income when you may not have actually had any dividend income. And also, the financial arrangement rules can really provide quite a shock for people. So the way this works is that over time, we have a set of rules which spreads the income, and it also will bring into tax whether you make a foreign exchange gain or loss. So that FX movement gets brought into your tax calculation. Okay. If you're doing it on a annual basis, so we're looking at that FX movement year on year, that's when you're when you're not a cash basis holder.
So this is what you're saying is awesome, because you're breaking it all down. Can we rewind just a little bit, just so I'm really clear, with the financial arrangement piece? Can you just define what that is again?
So this is where it includes all debt instruments, it's a really broad definition, but basically any cash that's not New Zealand dollar denominated, loans, bonds,
doesn't matter if it's assets or liabilities.
It doesn't matter if it's assets or liabilities.
Right. We're not talking about net equity position here.
No. So we're looking at anything. So quite often you might find on that UK rental property, there's a great big loan on it. Mm-hmm. So you've got a property which is denominated in sterling. You've got a loan. So there's a natural hedge.
Correct. Yeah.
For New Zealand tax purposes, in terms of who is a cash basis person, that is defined, and we look at the absolute value of all your financial arrangements. Okay. If they're more than $1 million, and or you've got income of over $100,000 under your financial arrangement rules.
Yes.
Then and the difference in the accrual income versus the cash income is more than $40,000, then you're in these rules of requiring to revalue. You're not what's called a cash basis holder.
So if I had a 500,000 New Zealand dollar equivalent property in the UK with a theoretical $500,000 mortgage on it, again it's theoretical, that is 500 plus 500, so $1 million?
No, we're just looking at the 500. So if that's all you had, then you'd be what's called a cash basis holder.
Okay.
And if that's the case, then the whole foreign exchange movement gets picked up when you close out, when you sell the property and dispose of the loan.
Sure.
If you are not a cash basis holder, we look at it annually.
Sure.
So you're actually still having to return the same amount of income over time. It's just, do you do it annually or not?
I see why at the end. Yeah.
And where it becomes quite tricky for people on an annual basis is that, the currency can swing around. So one year you can have a gain, next year you can have a loss. So you've paid tax in year one and then suddenly you've got a loss. Now you can use that loss against your other income, but sometimes you can't. And so you can have real differences in that cash flow.
Yeah.
And we don't revalue the property, so we only look at the loan. Okay.
Do you think that this causes an unpleasant surprise for 50% of people who kind of come to New Zealand? Is it less than that?
I would say it's probably an unpleasant surprise for 90% of the people that come to New Zealand.
Right? And where's the problem with this? Because before you make a trip and make a decision like this to move to another country, you're going to be researching a few things. You're going to try and find out is this kind of information just not, is it too complicated for most people to understand, and that's why people don't go there? Or is it just not broadcast?
I think a lot of people think of coming to New Zealand as, lakes and sea and mountains.
Yeah.
And they don't really understand. It's often heralded, New Zealand doesn't have a capital gains tax regime. But actually, we've got so many other regimes which are kind of like quasi capital gains regimes, and our rules around those financial arrangements are different than other countries in the world. Similarly, our FIF rules are very different. So they are the two real differences that people see, and they don't quite expect. I was just talking to a client yesterday where the overall portfolio was a loss. But it turns out that there's actually financial arrangement income, so they're going to have to pay tax on something which seems to be a loss.
Which is really hard, especially for in the next couple of years, if there's a pullback in markets and property in particular. That's going to be really hard because they may still have a tax obligation when their asset values are low, and for whatever reason that might be cash strapped.
Correct.
And that could be really difficult. Because the tax gets paid to who? It's paid to the New Zealand government, right?
Well, we pay to the New Zealand government.
Yeah.
And then on that rental, so as an example in terms of that rental property, they'll be paying tax over in the UK, returning their rental income. But of course, it's a sterling calculation. We in New Zealand will calculate the income on that rental income according to our rules. So we'll apply our depreciation rates on certain assets, we'll return our income. We won't be claiming our interest deductions because we can't now.
And it's New Zealand dollars.
So we translate that rental income into New Zealand dollars. But then also we need to pick up the foreign exchange, the financial arrangement income in relation to the loan.
That's right.
So you can get quite big differences.
Yeah.
We'll take a tax credit if there's UK tax that's been paid on that income because we're entitled to, because it's sourced over in the UK. But we can only take that up to the New Zealand liability on that income. So if you're in it depends on how that income calculation works out. But sometimes you end up forfeiting a bit of the foreign tax credit. Sometimes you can fully utilise it.
Okay. And the key thing here that I guess I would be really, really concerned about and really keen for people to understand is the fact that there might be a tax obligation to pay even though there hasn't been an underlying change in what you own overseas. So if you haven't sold that property in the UK yet, and it's still being, doesn't mean that you don't have to worry about tax. So just to really clarify this, at what levels do people need to kind of be thinking about, actually I need to make sure I've got some money set aside for this?
Well, if you are in those rules on an annual basis, you need to make sure that you're thinking about this. So this is if you are not a cash basis person.
Yes.
So this is where if you look at the absolute value of all your financial arrangements as being less than or more than $1 million.
Okay, so that's the key trick. So,
or there's another test also where the total income is
correct.
Is less than $100,000, and then we look at also the difference between the accrual and the cash method.
Okay.
But,
in other words, go see an accountant is basically the message of this show, right?
Yeah. Well, exactly, and that's true. Just don't ignore it. People are often saying, "Yeah, but I pay the tax over in the UK." It's like, well, yes, you do, but if you're now on the full New Zealand tax base. So that's why, coming back to your original example, the Kiwi that's been away for 5 years, they're not a transitional resident. So if they shut up shop over in the UK and move permanently back to New Zealand, as soon as they are a tax resident here, they are taxed on their worldwide income. There's no
transitional
4-year period to kind of take a breather, sort everything out and have a look at things. You're in. Right. And we will tax you from the moment that you are a tax resident.
And for all intents and purposes, this is a fundamental rule that we can apply no matter the country, right? The US, India, Taiwan, Nigeria.
Yeah, we will tax on a worldwide basis. We do have tax treaties with other countries. So these treaties, the purpose is to mitigate the effect of double taxation, but it also gives tiebreaker tests for where someone is also still regarded as a resident in the other country. We have a whole series of tiebreaker tests.
Okay.
So that might apply where you have someone who actually has kept a home, who still spends quite a bit of time in the UK. We might look at, okay, how do the tiebreakers work to determine where the residence is.
Okay.
But in the scenario where someone's actually moving back permanently, they're likely to become a non-resident in their country, so we don't even go into the treaties in that instance.
Okay.
And US citizens, well, they're always subject to tax over in the US unless you revoke your residencies.
Yeah.
It can be really complicated for US citizens, and the IRS has very extensive reporting and compliance requirements.
So it is still kind of technically a little bit hard then, therefore, to simply be a worldwide resident and have properties all over the world. You can totally do that, but there's a lot of stuff to consider.
There's a lot of stuff to consider. And so a lot of my work that I deal with are these people that are usually a dual resident. Sure. We may have homes and investments in various countries.
Sure. Okay. So what about if we were talking to a New Zealander who's thinking, right, great, borders are open, I'm out of here.
Yeah.
Firstly, you shouldn't do that. Just stay here.
Stay here. Our labour market needs you.
Yeah, the labour market needs you. And honestly, this really is the best place in the world. Trust me. But let's say you did anyway. You went against my advice. You went to Australia and you kept your home. You rented it out. Is there anything weird that you need to be aware of when you go to Australia? Like if we reverse this.
So the same things. We then will look at, okay, are you becoming a non-resident here? So our non-residence rule will be, so you're already a New Zealand resident and then you're leaving. So you become a non-resident when you spend 325 days out of New Zealand in a continuous 12 months period, or when you no longer have what's called a permanent place of abode. So it might be that, for example, the home that you own, if you still hold it, you will rent that long term, so it's not available to you, it becomes a rental property. Okay. You need to think about, we'll also look at, well, are you still keeping effectively your life here, or are you actually closing down your bank accounts, finishing up on your memberships, you're closing everything down and actually permanently moving. So if you're in that category of the permanent move, the things we need to think about are how this affects your the treatment of your investment portfolios. You can get a deemed disposal of your interests, and that's as you effectively exiting the regime. And then on the Australian side, and I'm not an Australian tax advisor, they will have their set of rules because you will be becoming an Australian tax resident. Sure. Now, they have capital gains tax, and so you may find you have a cost base. You may find that you need to be thinking from an Australian tax perspective, what's the treatment of that property that I still own here? Now, I will probably add here, and this goes for whether you're coming or from or moving or to, if you've got trusts, you need to be very careful about how that transition works, because the New Zealand tax rules relating to trusts are quite different than in Australia. And also, if you have a trust which was created or settled offshore by a non-resident settlor, then we have very specific rules about them. So just flag those up. If anyone has trust, you need to be very careful. Okay.
So just to be clear, if I owned an investment property that I only purchased a year ago, this deemed disposal thing, that doesn't actually impact?
Correct.
Okay. All right, well, that's cool. So we know basically that if you have interest in other countries, especially property, especially trust, you absolutely need to get advice. Don't think that this is simple, right? Like, because what happens if things aren't actually taken care of here and people kind of forget about it? What happens?
Well, you can end up getting into a real pickle, really. Yeah. Quite often you find out years down the track or through that process that actually you have a New Zealand obligation in relation to income, and it might be amounts that you didn't even derive. It could be this deemed income that we have. Yeah. And also, particularly if you're a transitional resident, you might find that actually you had this window where you could have restructured and sorted things out, and you might have wasted that period of time. Okay. So there's quite often we use that period of time to actually kind of look at all the tax efficiencies and get your get your house in order.
That's right.
Before you're going into the new regime.
Yeah.
And if you have got unreported income, then we should be making a voluntary disclosure to the IRD.
Okay.
And you'll be reporting, and then you would be looking at whether there may be interest, depending on how you handle it. There may be penalties, or you may be able to get those remitted.
Okay, good. One more question before we kind of come in for a landing here. I want to just quickly touch on the bright line test, the non-deductibility of interest, all the other raft of pleasant new taxes that we've seen over the last few years. A lot of people that I'm talking to are kind of trying to make some medium to longer term financial decisions, and tax often comes into the piece. And then, no doubt, inevitably, they're going to be asking me around, well, who do you think is going to get into power? Because maybe I should factor that in with what I'm doing. So are we safe in assuming, and I know I'm kind of asking you to go a little bit off your track here a little bit, but are we safe in assuming that if a certain other government comes in, it really is just as simple as they will just get rid of those tax rules, and we can kind of just, or are we kind of dangerous in doing that? Because we have to kind of make decisions based on what rules apply today.
Well, obviously we've got the rules that apply today. National have indicated that they will wind back the interest deductibility changes, and they'll also wind back the bright line back to 5 years. So if we take them at face value, we could assume that.
Yeah.
Whether they actually do it or whether there's a transition out, who knows, really. And I suppose it depends on who their coalition partners are and the extent that they can get the legislation through. If the current government was to stay in, I wouldn't be surprised if there was some more movement in taxes. There has been a big information gathering exercise recently, which is looking at the high net worth category of taxpayers, and is looking at the amount of economic income versus taxable income. It'll be interesting to see whether the trustee rate changes or some other form of taxes come in under the next election.
Okay. If I bought an investment property and the current 10-year rules applied with the bright line test, and I was caught up in that, and let's say National got in and they changed that, they wound that back, am I still going to be governed by the 10-year rules even though they've changed it going forward?
They would probably change it. If there was a change, it would change prospectively, because we look at the tax treatment when you dispose of your asset. So if they change the 10-year rule back to 5, then we'd be under 5.
Okay.
But assuming there was no change to that rule, then we're stuck with 10 years, and obviously 5 years for new builds.
Okay. Fascinating times here.
Yeah, there's a lot of a lot of uncertainty.
Yeah, we love complexity in our tax law here in New Zealand, don't we?
Well, we do, and actually I think people generally underestimate, and certainly the revenue when the legislation's being drafted, how complicated these rules are.
Yeah, it keeps people like you pretty busy though.
We are busy, yes.
Yeah. So on that, where can people go? Like, obviously you're not your mom and pop sort of local mechanic type accountant. You're an accountant to the accountants. You're a specialist tax advisor. So you're dealing with a different set of clients. But where could people go to find you if they're, and maybe even describe your ideal type of client, just so people know who should contact you?
So you can find me on through my website, which is www.taxadvisory.co.nz.
It's amazing that name was available.
I know.
That's such a cool name. Taxadvisory.co.nz.
Well, it just says what it is.
It is. It says what it is on the tin.
And in terms of the clients that I deal with, it could be, mum and dad that have got a property that are looking to do a subdivision, or are concerned about whether their property is going to be subject to tax or not. It could be a SME type business that has got some particular tax issues that they need to help with, and often I'll work in with their accountant or their lawyer.
Yeah.
As you said before, I work with quite a lot of the new migrants that have come, or returning Kiwis that are coming to New Zealand, to help them navigate through our rules.
Yeah.
And I do quite a lot of work also in that trust space as well.
Okay, cool. Very, very important to keep your number on speed dial. So just remember taxadvisory.co.nz if you think you need to have a chat to someone like Amanda, do it sooner rather than later. Awesome, Amanda. Really appreciate your time. Thanks again for sharing with me on the show.
Thanks for having me, Darcy.
No worries. Cheers.